Here's the deal. Based upon analyst numbers, NVIDIA right now is trading at a forward P of 50. Now, they just said they're going to do 60% plus revenue growth next quarter, right? So I can tell you a 50 forward P when you got 60% plus revenue growth is not a high valuation at all. Never mind that. Analysts were just massively wrong with their prediction. They thought NVIDIA is going to come in next quarter with $7 billion. NVIDIA says they're going to do $11 billion, right? Okay, let's think about this logically for a moment. Do you think maybe they're a little lowballing these EPS numbers, and maybe in this fiscal year, NVIDIA could come in with, dare I say, $8.50, $9.50, $10 EPS? Have we considered that? So maybe, just maybe, the forward P in terms of this upcoming fiscal year, the one we're in right now, maybe we're at a 40 right now, and maybe the following year is at a 30. These are things you have to consider, right? Have to consider this stuff. So just bad takes all around, man. Bad takes all around. It's a more sophisticated game than just being able to put on a tweet, this and this and this. It's a little more complicated than that. And that's why there's arbitrage in this game. That's why there's a lot of money that can be made or lost, right? Now look at this. This is a tweet I saw out there. The ratio of NASDAQ 100 to Russell 2000 stocks is now retesting the peak of the tech bubble levels. Situation similar to today where smaller companies perform poorly compared to large cap companies, right? So one is people look at this and they say, oh my gosh, all these stocks got to crash. NVIDIA's got to crash, right? Amazon has crashed. Apple, Microsoft, all these companies all got to crash to the floor, right? So it's always a possibility, always a potential, always something that can happen. But you know what else could happen? Gosh, maybe these Russell stocks, these small cap stocks that have been underperforming for 5 flipping flapjacking years, maybe, just maybe, they wake up over the next 12 months and they start coming back to life. And maybe the Russell starts outperforming some of the other indexes. These are things you have to consider, okay? There's 2 ways you can get there. Or maybe some of the NASDAQ 100s come down a little bit and the Russells step up their game, right? There's a lot of different ways that this game can be played now at this point in time, right? Cheesecake Factory. Cheesecake Factory is a little over $30 a share right now. And this is a pretty easy money play in my opinion, okay? Cheesecake Factory, I mean, if you haven't been to the Cheesecake Factory, have you even lived a life yet, okay? You got to go to the Cheesecake Factory at some point in life. Get one of those cheesecakes that has like 1,000 calories in it. Oh, so good, and makes you have to go to the gym for 6 hours, okay? Cheesecake Factory, obviously, arguably the most successful standalone restaurant in the United States of America, okay? And there's obviously international locations as well, but it's absolutely incredible. But the thing that's hidden about Cheesecake Factory is they own this other brand called North Italia. I can tell you this opportunity for North Italia is immense. I can see there being hundreds of North Italias around the United States of America over the next 5-10 years. This North Italia, it's phenomenal. I've gone to several locations, and I can tell you I've tried everything on the menu, and it's amazing, okay? The chefs there are phenomenal. Their recipes are insane. And I can tell you, when people go to North Italia, a lot of people like to drink. Some people drink too much, okay? Let's just put it that way. Now, in regards to North Italia, here's the deal, okay? And remember I talked about drinking earlier? That's a straight profit business, okay? Here's the deal. As I say, men lie, women lie, numbers don't lie. Look at the numbers, okay? The first quarter of 2023 comp store sales versus Q1 of 2022, 9% up year over year, okay? As far as the first quarter of 2023 comp sales versus the first quarter of 2019, they're up 30%. 30%, okay? And so this is a brand that has incredible opportunity. And you see even the company mentions, potential for 200 domestic locations over time. I can see there being easily 200 domestic locations over time. Incredible opportunity. Now, here's the thing about cake. They don't just own Cheesecake Factory in North Italia. They also own all these other brands. And basically, these brands are kind of like them testing to see, are these the next North Italia? Are they the next Cheesecake Factory? What are the margins looking like? What are the revenues looking like for these different, brands, right? These different restaurant chains. What's the wait time on a Saturday night looking like? Or what about the wait time on a Wednesday night, right? And so this is just kind of like, when you're buying into a lot of these different restaurant companies, you're kind of just getting a few of the brands that they own that are successful. This one like to try a lot of different stuff and see what clicks and what doesn't. I think it's brilliant idea. Now, they're also expanding units right now, okay? So they're expected to grow and basically have 20 to 22 new units planned for this year, okay? Now, that compares to 14 new restaurants opened in 2021 and only 13 new restaurants opened in 2022. So this means growth is coming, okay? Now, I think they can open easily 25 to 35 new locations every year for as far out as I can see. When I look at all their different restaurant opportunities here, and when I just think about the North Italia, like North Italia, they could start opening 10 to 15 North Italias easily a year, in my personal opinion, right? And there's always room for some more Cheesecake Factories out there. So I don't see this slowing down. If anything, I wouldn't be surprised if the following year they open 25. Never mind if there's a situation where the commercial market weakens more. I think that could, open up some other opportunities, right? Let's say there's a weaker economy, some of the let's call it not as well run restaurants go under, or there's a situation where, some retailers that, are kind of questionable that, taking up a lot of space out there. I think the opportunity for this company to grow 25 to 35 units a year is immense. Now, here's the deal, okay? Cheesecake Factory is the big dog of the entire restaurant space. If you look at highest unit volumes, Cheesecake Factory eclipses everybody by a large margin. Okay, a large margin. Now, Texas Roadhouse is a company I also personally own. Texas Roadhouse, great company. Okay, maybe even better well run than Cheesecake Factory is debatable. Both are phenomenal. Texas Roadhouse has a better balance sheet. Okay, but the bottom line is nobody's doing the numbers. No one's doing the numbers that Cheesecake Factory is doing, okay? Now, there's always a lot of worries about recession. What happens if recession? Do they start losing money? We can look back at data. That great thing about Cheesecake Factory, they've been around for a long time. We can look back, okay? 2008, profitable, very profitable. 2009, profitable. 2010, profitable. Now, this was in a horrible economy, right? We were battling around 10% unemployment. A lot of people felt like the government numbers were not, let's just call it that, reliable, and we actually had 15 or 20% unemployment. Not going to get into that debate. But nonetheless, folks, okay, the economy was horrible in those years, and Cheesecake Factory still did very well. And you even look at free cash flow. Look at 2008, $85 million free cash flow. 2009, $163 million free cash flow. 2010, $128 million. Even in those bad economic years, they were still putting up nice numbers, very nice numbers. Now, I want to draw your attention to something very important here, okay? And that is 2022. So, obviously 2022, bad numbers. These are bad numbers for Cheesecake Factory. $1.51 EPS, right? $50 million free cash flow, very bad numbers. So what happened? Well, inflation happened. Worst inflation in decades that they had to battle. Price of everything, I don't care if you're talking about tomatoes and eggs or pasta or whatever it is, that went into their business. Wages went up immensely. And it's a really tough thing for restaurants to battle. And, ask your local restaurant how they had to deal with that. It's very, very difficult. And so just do keep in mind the profitability and free cash flow should be in a much, much better place over the next several years than it was this past year, regardless of actually the economy. Now, here's the deal. I'm getting this company for a dirt cheap valuation, okay? I mean, absolutely dirt cheap. They're expected to do, this is analyst average, 274 of EPS in 2023, 338, 2024. Here's the deal. I'm paying like 11 times this year's expected numbers. I'm paying less than 10 times next year. I mean, for a company that, in my opinion, is going to be opening 20 to 30 new restaurants a year and is going to be able to grow revenues on top of growing EPS at a much more substantial clip, especially over this next couple of years, this is kind of dirt cheap valuation for me. And so I really like it from that context, right? Now, on top of that, here's the other important point. Cheesecake Factory pays a 3.36% dividend yield, all right? Now, here's the deal. Remember those EPS numbers we were talking about? 274 is expected this current year, 338 next year. Well, here's the deal. They're only expected to pay out a little over $1 of dividends, right? So what this tells me is likely the amount of money they're going to be able to pay in dividends in future years is going to be immensely more than what they're paying now. So although I'm buying the stock right now and it looks like I'm getting a 3.3% dividend yield, right? In reality, I believe for the shares I'm buying, my dividend yield will really be 4%, 5%, 6%, 7%, 8%. And that will happen pretty darn quickly. And this is a beautiful thing about buying dividend stocks when they're really undervalued, which is a rare opportunity you kind of get in the market, is when this is a situation that happens, and I experienced this with a stock like TPR, like I own, Tapestry. right? Where when I was buying that stock, it was a great high dividend yield already. And now, based upon the shares that I bought for that company and based upon the dividends they're paying now, like I'm getting some insane yield. As somebody did the calculations on it, I think it was something like an 8 or 9% dividend yield every year. So I'm making a huge return on investment, and I don't even need the stock to go up. Never mind if the stock price appreciates over time, which obviously great companies do. That's just another lever there, right? And that's a beautiful thing. And that's one of the most, what I just shared with you right there, that's one of the most underrated things about dividend stocks that you never hear talked about, is the companies that continue to grow are going to be able to up their dividends more and more and more. And the dividend yield you're getting now is small compared to what you'll be getting in a few years. It's very similar to real estate, becoming a real estate investor. If you know anything about real estate investing, right? There's two exciting things with real estate investing. One is you buy the property, and guess what? Homes appreciate over time. So whatever you're paying for the property today is likely going to be a lot cheaper price than that home would sell for in 10 years, 20 years, 30 years. The other thing is the rent you can make. But not just the rent you make today, but the rent you make next year, the following year. That's a beautiful thing about that. And it's a very similar concept to dividend investing, okay? Now, in terms of building out portfolios, and kind of my 2 cents on this, right? You got to stay focused out there. You got to stay building your portfolios. And the same opportunities of last year are not the opportunities of this year. Opportunities you might have got 6 months ago are not the best opportunities today, which today's opportunities you're taking advantage of will not be the same opportunities 6 months from now, okay? And so if I look at something like Meta, right? Meta was a tremendous buying opportunity, right? Last year. I put $77,000 in Meta stock in a day. Like that was one of the craziest buys I've ever done in my life, but it was like stealing money at that time, right? And so when I look at something like Meta, I have 0% interest in selling the stock because ultimately I believe Meta's probably a $400, $500, $600 stock in a few years. So I really don't have any ambition to sell the stock, especially when I know the crazy numbers that are coming from Meta over the remainder of this year. The EPS numbers and net income, wait to see that over this next 3 or 4 quarters. Going to knock your socks off, in my opinion. So I'm in I have no reason to sell the stock right now. 0% reason. Now, on the flip side, right? As long as you're always in a position where you have more income than expenses, which I hope everybody watching this does, and if you're not in that position, get on that ASAP, right? Get more income than expenses. You're always in a position to buy, right? And so you can take advantage of different opportunities out there. In the market right now, what I see, a lot of opportunities in value stocks, in dividend stocks, and in different growth stocks than last year. I mean, PayPal is a tremendous opportunity in this market. And, Metas, Palantirs, those sorts of stocks are certainly still opportunities. There could be money made. It's just not that crazy money now at this point in time, okay? And so just continue to be focused out there, build out your portfolios, build out positions you're going to be proud of holding for the coming years, okay?